Hi everyone, welcome to Clone Compounding, where our mission is to learn from others in order to achieve financial independence. Today, we'll be looking at top 3 takeaways from Berkshire Hathaway's 2021 annual letter by Warren Buffett. We all know these annual letters carry a lot of wisdom, so let's get into it. Number 1, business pickers versus stock pickers. Warren says that their goal is to have meaningful investments in businesses with both durable economic advantages and a first-class CEO. He emphasizes that we own stocks based upon our expectations about their long-term business performance and not because we view them as vehicles for timely market moves. That point is crucial. Charlie and I are not stock pickers, we are business pickers. People who know Berkshire know that has largely 2 segments. 1, businesses owned and operated by Berkshire, and 2, investments in marketable common stock of major US companies. One advantage of our common stock segment is that on occasion, it becomes easy to buy pieces of wonderful businesses at wonderful prices. That shooting fish in a barrel experience is very rare in negotiated transactions and never occurs en masse. It is also far easier to exit from a mistake when it has been made in the marketable arena. Cash versus equities. Berkshire's balance sheet includes $144 billion of cash, and of this sum, $120 billion is held in US Treasury bills. Charlie and Warren have pledged that Berkshire will always hold more than $30 billion in cash. We want our company to be financially impregnable and never dependent on the kindness of strangers or even that of friends. Both of us like to sleep soundly, and we want our shareholders to do so as well. But $144 billion US, why? Warren assures that it's not because he and Charlie have lost their overwhelming preference for business ownership. He reminds us that 80 years ago he purchased 3 shares of Citi Services preferred stock. The cost was around $115 and required all of his savings. The Dow Jones Index that day closed at 99, a fact that should scream to you, never bet against America. Warren has always kept at least 80% of his net worth in equities. His favorite status throughout that period was 100% and still is. He says Berkshire's current 80% or so position in businesses is a consequence of his failure to find entire companies or small portions which meet our criteria for long-term holding. Charlie and I have endured similar cash-heavy positions from time to time in the past. These periods are never pleasant. They're also never permanent. And fortunately, we have had a mildly attractive alternative during 2020 and 2021 for deploying our capital. Increasing value of the investments. Warren talks about 3 ways of increasing value of shareholders' investment. The first is always front and center in their minds. Increase the long-term earning power of Berkshire's controlled businesses through internal growth or by making acquisitions. Today, internal opportunities deliver far better returns than acquisitions. The size of those opportunities, however, is small compared to Berkshire's resources. 2, our second choice is to buy non-controlling part interests in many good or great businesses that are publicly traded. From time to time, such possibilities are both numerous and blatantly attractive. Today, though, we find little that excites us. This is mainly because long-term interest rates that are low push the prices of all productive investments upwards, whether these are stocks, apartments, farms, oil wells, whatever. Other factors influence valuations as well, but interest rates will always be important. 3, our final path to value creation is to repurchase Berkshire shares. Through that simple act, we increase your share of the many controlled and non-controlled businesses Berkshire owns. Periodically, as alternative paths become unattractive, repurchases make good sense for Berkshire's owners. During the past 2 years, we therefore purchased 9% of the shares that were outstanding at year-end 2019 for a total of $51.7 billion. It should be noted that Berkshire's buyback opportunities are limited because of its high-class investor base. If our shares were heavily held by short-term speculators, both price volatility and transaction volumes would materially increase. That kind of reshaping would offer us far greater opportunities for creating value by making repurchases. Nevertheless, Charlie and I far prefer the owners we have, even though their admirable buy and keep attitudes limit the extent to which long-term shareholders can profit from these repurchases. Alright everyone, that's it from us. Thanks so much for watching and hope you enjoyed this video. Please smash that like button and subscribe for more such videos.